Welcome to the Real Estate Guys radio program. I'm your host, Robert Helms. Sometimes we buy a property for cash, but usually we get financing, and lately that has changed so much, we thought it was time to update listeners on the commercial mortgage markets, what to look for, and what comes next. And we've got a great guest today on the Real Estate Guys radio show. The Real Estate Guys are throwing a party and you're invited. Join us at the New Orleans Investment Conference, November 1st through 4th. Now in its 49th year, it's the world's longest running investment conference and features some of the biggest names in economics and investing, including James Rickards, George Gammon, Danielle DiMartino Booth, Rick Rule, and Peter Schiff. The Real Estate Guys are speaking in multiple sessions, attending lots of others, and we're hosting an invitation-only party one of the evenings for our friends and listeners, including some VIPs for you to mingle with. So make your plans to join the Real Estate Guys, the New Orleans Investment Conference. With all that's going on in the world, no serious investor can afford to miss it. Send an email to neworleans@realestateguysradio.com and we'll get you all the details. That's neworleans@realestateguysradio.com. And we'll see you there. Welcome to the Real Estate Guys radio program. I'm your host, Robert Helms, and joining me, our co-host financial strategist, Russell Gray.
Hey, Robert.
You can buy real estate for all cash. And if you have a lot of cash, you can buy a lot of real estate. But one of the great benefits of real estate is leverage. You can borrow the money that you need to buy most of the real estate. If you're buying a single family house, it's not uncommon for you to put 20% down and the bank to loan 80%. And that's great news. But as we all know, financing has changed drastically in the last year, and it's harder than it's been in a long time to afford those payments.
Yeah, it's been actually quite a change. You know, the Fed took a very aggressive interest rate hiking cycle that translated directly into the bond market. And in the bond market, which is where mortgage money tends to originate, at least from a pricing perspective, it has had a real impact in affordability. And the irony about this is a couple of things that a lot of people don't understand. So when you jack up interest rates, it means that the bonds that people currently hold go down in value because they're throwing off less cash flow than the current bonds are. And so you have to lower the price to meet that cash flow. So it's an inverse relationship, just like apartment buildings and cap rates. And so that creates problems on all balance sheets with people that are holding bonds. Sometimes it causes a tightening of lending. The irony is that when lending gets tight and real estate gets more difficult to purchase, it's actually a good time to be a buyer if you can find alternative forms of financing, because later on when the credit markets begin to heal and interest rates normalize, then you're the beneficiary. But you do have to change. And for the longest time, at least the last 10, 15 years since the great financial crisis, we've been enjoying pretty low interest rates and pretty liberal credit markets. And that's all changing now. And so when the tools change, some of the strategies and tactics have to change too.
Yeah, a few months ago, I was on a call with our friend Ken McElroy, and he and I have been investing in real estate about the same amount of time. And he said, you know what? The average interest rate over the time that you and I have been investors is higher than the current interest rate. And I'm like, oh my gosh, you're right. Because of the early part of my career, you know, interest rates were 9, 10%, 8.5%. I kind of skated the 18 and 19% interest rates. My dad, of course, was part of that whole world. You know, my dad used to say, the godfather of real estate, if the interest rate is a single digit, then take it. Like that's good compared to what he had seen over his multi-decade career. But if you've only invested in the last 5, 6, 7, 10 years, you've only known low interest rates. And I think the rise of interest rates is a problem, right? It costs more to finance the same amount of real estate, but it's also the speed, just how quickly rates changed.
Well, and again, the inverse of rising rates is falling values. Certainly multifamily has seen that. The other thing is a lot of consumers use debt to purchase homes or cars and credit cards and things like that. So it eats up some of their purchasing power, whether they're on the buyer side or on the renter side. And a lot of people who put together what they call their capital stacks, their debt and their equity, and how are they going to own the bigger properties, for example, took advantage of some tools they call bridge loans, short-term loans that have fairly quick adjustable rates. And the problem is when rates are stable, you can kind of absorb those adjustments. To your point, Robert, when things start changing very quickly, especially more quickly than anticipated, And it's a double whammy because you've got the interest expense going up. At the same time, you're having a harder time pressing the rental growth and income. And some folks out there get squeezed right now. There's a little bit of stress. And so it's going to be really interesting to see. This is where the weak hands get shaken out. And it's always sad when that happens. And even worse, it frightens people away from an asset class where really, if you see the more sophisticated, the more experienced investors, they've been preparing for this. They saw it coming, and now they're beginning to see the opportunities, maybe not fully developed yet, but coming to be able to step into those markets and acquire some of those distressed assets, get them kind of restructured, and then wait until the credit markets come back to where they need them to be, and then put new financing on, and the game begins again. It's no fun if you're inexperienced to be in this part of the cycle, but it's a lot of fun if you are experienced because you know what's coming.
The one constant in interest rates is change. And it's not just the rates. The other thing that happens is the loans change, the parameters change. When COVID lockdown happened, all of a sudden lenders required more reserves, and everything changes regularly, which is why we like to check in with someone who really knows this stuff. We come back, you're going to meet our friend Anton Mattli. He's in the business of originating commercial mortgages, and he sees it all today on the Real Estate Guys radio program.
Live nationwide, you're listening to The Real Estate Guys. Find out more at realestateguysradio.com.
Are you achieving everything you want in life? What if there was a time-tested way for you to get everything you've ever dreamed of? The most successful people in life set goals and keep themselves accountable. But how? The good news is that it's not rocket science. You too can learn the skills and unleash the motivation that will create success in your life. Hi, this is Robert Helms, and I'd like to personally invite you to attend Create Your Future, the 2024 Goals Retreat, January 12th to 14th in Dallas, Texas. This unique weekend event has been called phenomenal, inspirational, and life-changing by the thousands of people that have attended. Hear from some of them and find out more at goalsretreat.com. Get your life back on track, physically, spiritually, and financially. Attend the 2024 Goals Retreat on the second weekend of the new year. Visit goalsretreat.com to learn more and get on the advanced notice list. This is no dress rehearsal. Live the life you were meant to. Visit goalsretreat.com or call 888-489-7723 extension 18. That's goalsretreat.com.
Hi, this is Kevin Harrington, an original shark from the hit TV show Shark Tank, and you're listening to The Real Estate Guys.
Welcome back to the Real Estate Guys radio program, now in our 27th year of broadcast. Thanks for tuning into the program. We're talking about the financing associated with purchasing real estate. Not everybody uses a loan, but there's lots of reasons to like leverage. Let's welcome to the program from Peak Financing our friend Anton Mattli. Hey, Anton.
Hey, Robert.
Good to see you. And I know things have been easier in the past when interest rates were good and people were handing out money. But you're a guy that is in this space every day. You stick close to what's happening. Paint for us the picture of just how this change has affected your industry.
Yes, so it has changed everyone's life tremendously. Right? You mentioned earlier the speed of the rate change has been unprecedented, and that is really one of the key differences to the past. Right? When rates go up slowly, you have the ability to adjust accordingly, and the shock level is just not there. What we have seen with Fed rate and then the short-term borrowing rates for commercial real estate borrower, which is the SOFR rate, being at essentially at zero, and now currently being at around 5.3%. Within such a short period of time, obviously creates a lot of stress for everyone. And that's unfortunately what everyone now has to deal with.
Now, you're in the commercial side of the business, and we'll get into some of the specific asset classes. Your company does a lot of different types of loans. You personally specialize in multifamily. But let's first talk about what's happening in the residential markets. Because of the fact that interest rates change so drastically, you get lots of folks that might have otherwise been in a position to move who've decided, I don't really want to get rid of my 3% mortgage because I'd be forced to buy a property with a 7.5% mortgage. So that has definitely stalled the market. And I think that everyone's looking to what the Fed's going to do and when there's going to be relief and so forth. But right now it has constricted the market. Take it from there on multifamily. It's been a big change. Russ alluded to a lot of the properties that were purchased either with bridge financing or they didn't purchase rate caps and they're in trouble now. What's happening in the multifamily space?
Yeah, so speaking about single family homes and the situation there, obviously the cost to borrow has gone up significantly there too. And as you mentioned, Robert, anyone who has a mortgage that is below 4% is not selling their home. So there is not really much inventory for buyers in the marketplace. And that has pushed the prices up on the single family side. So that combined with the much higher borrowing cost of mortgage rates at 7% plus, naturally that makes it very unaffordable for a new home buyer. So what happens here? They are looking to rent, and there is not really enough inventory on the rental side to support that demand. So rents on the multifamily side have increased significantly in some markets during the peak time in 2021 into 2022. Some markets have seen more than 20% year over year rent increases, right? It's unbelievable. So that's the positive part, certainly being an investor on the multifamily side. Now, what does that create, however, is what Alan Greenspan, the term he brought up in 1996, the irrational exuberance, right? And that definitely, that situation we have definitely seen, particularly in 2021 into middle of 2022. Interest rates were at record lows. The Fed was tossing trillions of dollars into the market. So everyone had plenty of money to deploy. Lenders were willing to lend at record low interest rates. Yeah. And with that cheap money and free money to some extent, naturally everyone rushed in and started buying multifamily properties, right, which then resulted in some markets, property values virtually doubled within 2 to 3 years, right? So that was the negative part. As a result, because these values went up so much, if you wanted to have a traditional commercial real estate multifamily loan, you would have taken out a Fannie or a Freddie loan. But with these massive value increases, you would not have gotten more than 55% LTV. So bridge loans came to the rescue. Everyone was rushing to taking out bridge loans at 75 to 80% LTC, loan to cost. And very often they even added pref equity on top of that. So in order to buy these deals and make the numbers still work. So that was during 2021 to middle of 2022. In the meantime, obviously, we have now a situation where interest rates moved up significantly and values have come down already around 20 to 25%, depending on what market one is in. So a very different environment.
So, Anton, you still have folks that are interested in buying property. That happens all the time. Landlords don't think like consumers do. They'll pay a higher price if the return on investment makes sense. As you mentioned, rents are rising in certain areas. So when you look at the entire package, someone brings you a loan for consideration, you're going to look at the rent rolls, you're going to look at the marketplace, you're going to look at comparables and so forth. What does it take for a loan to make sense today?
It needs to cash flow in order to support that loan, right? So obviously when the loan interest rate was at 3%, the debt service coverage ratio, as we call it, was much of typically 1.25 of the net operating income. That was much easier to achieve than it is today when interest rates are essentially double. So as a result, the debt service coverage ratio is now much harder to achieve. So what does that mean? One needs to pay a lower purchase price in order to get a lower mortgage, which then supports that debt service coverage. So in other words, what deals do make sense, the ones that cash flow sufficiently support that new loan at a much higher interest rate.
Well, and of course, that is part of what we'll see as some of these properties don't make the turn. And we don't wish ill will on anybody, but the folks that did, let's just talk a minute maybe about a bridge loan. A bridge loan, as the name might suggest, is typically a short-term loan. In the past, people have used these kind of loans when they only need the capital short-term, like when I'm buying a building that needs a lot of work. I get a more expensive, shorter-term loan until I can get the units to a point where a more traditional loan makes sense, and then I'm able to refinance. And so at the time, people didn't know what the future was going to look like. So they decided, well, we can go in and make the numbers work with these loans. But now there's been all kinds of issues. And of course, people are paying attention to folks that are losing apartment buildings, banks that are taking back buildings, and none of that bodes well for the investors involved. But eventually the market does shake out those properties. And so if you're looking to buy, when is the time? Nobody knows. But I think part of the lesson here is you always have to understand what the financing looks like, because it changes a lot. I mean, we probably should have you on the show more often, but I know we talk at least twice a year at the Secrets of Successful Syndication. And it seems every time there's a new nuance or a new program or a new idea that you have to share with the folks, because the whole landscape changes based on what the money dictates.
Yes, absolutely. Again, that irrational exuberance was not just buyers, but it was also lenders, right? So even properties that were fully stabilized that would have qualified for an agency loan like a Fannie Mae or a Freddie Mac loan, borrowers still rush to the bridge loan in order to get that deal done. Unfortunately, these loans are typically 2 or 3 year terms, initial terms, and they are coming due sometime next year and the following year. And you could technically extend these bridge loans in a lot of instances. However, that comes at a great cost. You have typically to take out an interest rate cap for most of these loans. The interest rate cap cost has gone up significantly, and together with operating costs that also has gone up significantly, right? We talked on the positive side with rents going up, but unfortunately operating cost has gone through the roof for a lot of operators too. We have much higher payroll. We have much higher insurance, particularly in coastal areas like South Texas, Louisiana, all the way, or Florida, and property taxes in some markets too. So at the end of the day, a lot of owners and borrowers are constrained with their operating income. And as a result, with this additional borrowing cost, obviously to extend that loan is not easy to do. What does that mean now for them? What choices do they really have, right? So you bring in new equity so that you can extend that loan, or you attempt to sell the property. And these are typically the two choices that you have, right? We call it a capital event. That capital event comes up once that loan matures, and you need to decide as a borrower, should I bring in more equity? That means capital calls if you're a syndicator, or you sell the property. The problem is now the property value compared to where it was just 2 years ago tends to be 20-25% below that, unless you were in a position to significantly increase that NOI, which, as I mentioned, for a lot of operators has been a challenge because of the increased operating cost. So as a result, a lot of operators that have taken out these high leverage bridge loans are now in trouble. They need to find a solution. And we help them as much as we can, but in a lot of instances, there is just not enough meat on the bone, if you want to call it that. And some of these deals will unfortunately have to go back to the lender or have to be sorted out with a buyer before it goes into foreclosure. The advantage is if you are on the buying side, there will be quite a bit of opportunities over the next 6 to 18 months as a result of that.
Well, and as the market changes, we'll certainly be watching for those opportunities, but you hate when it's at the expense of people losing their equity. And that's exactly what is happening. You know, when I remember when the rate cap thing was just starting, in fact, it was one of the things we talked about, a couple of years ago when you started to see people take this precaution. And back then, a rate cap wasn't very much. You know, you on a big apartment building, you might pay $40 or $50 or $100,000 to ensure that the rate wouldn't adjust too high, or actually once it did, the insurance, if you will, kicked in. But we also saw a lot of people who thought, well, that seems like a waste of money. I'm not going to do that. In hindsight, they wish they did. Some of these same rate caps, these years later could be close to $1 million.
Yes, absolutely. Right. So back then, like for a $10 million loan, you could have bought a 2% strike rate cap for maybe $60,000, $70,000 for a 3-year coverage. If you just want to renew that for 1 year, that 2% for 1 year, today you probably would spend around $350,000, right? So that is, even if you had a rate cap, just to extend that for another year is really costly. What we also have seen, the ones that have not taken out interest rate caps, and the lenders allowed it in some instances, they were already the less experienced operators that also didn't raise enough money to begin with for the deal, so they didn't have enough reserves. And some of the foreclosures we have seen already are clearly the result of that, right? So not all syndicators have done a terrible job. The ones that we already have seen, it was almost like the perfect storm for them, right? No rate cap, not raising enough money, bringing in 80% loan to cost maximum leverage and pref equity on top of it. It was already a given that they would run out of money very quickly. That unfortunately is happening to some. And we feel sorry for them, but it's an opportunity for the ones that can take over these properties.
I think there's another thing to talk about, Anton, and that is that with commercial financing, it's not like residential. If you've only ever financed a 1 to 4 unit property, pretty easy to refinance. And a lot of people, rates go down, half a point. They look at the math. They go, yeah, I'm going to refinance my loan and save a few dollars every month. Well, you do have to watch that because every time you do that, you're pushing that amortization period out, but we'll save that for another day. My point is that with commercial property, that's not how it works. You get a loan, usually for a set term. So what about the folks that maybe got into a 5-year loan 4.5 years ago? Right? 4.5 years ago, interest rates were great. You might be in an apartment loan at sub 3%. And now rents are up from then. So the property probably has gone up in value, even though it might have adjusted recently. Your investors are looking good. Now you're kind of forced to sell, which means there needs to be somebody in the marketplace, or to refinance at those higher rates. But I think the distinction is, you don't have a choice. These kind of loans expire. What do you see coming down the road in terms of expiration of current mortgages?
Yes, it's a good point. Now, I would say anyone who has taken out a loan or has bought a property, multifamily property, let's say 2018, 2019 or earlier, they are still in a very good spot, in generally speaking, right? Because they bought at lower values, and as you mentioned, rents went up. Even if they had to refinance, they certainly should have a sufficient amount of cushion there that they are able to refinance. Many of them obviously thought that they could sell at a significant profit, which is likely not as high. And they may have thought about refinancing, which is not as high as a cash out refinance as they anticipated, but at least they are still in a good spot. I would say most of them are. Having said that, there are still, in the commercial world, we have a massive amount, $1.5 trillion that comes due over the next few years, right? So, and we do not just talk about multifamily, we talk all about commercial real estate loans. That includes office buildings. Many of us have heard of all the disasters that are happening with office buildings. And unfortunately, whatever is happening in other commercial real estate asset classes may also have a negative impact on your ability to borrow at significantly good rates on the multifamily side or any other asset class. So that is what is kind of a warning sign that I want to put out there. I call it a contagion risk that we have here, even though office buildings obviously are in a very tough situation. Many of them will go in foreclosure. And multifamily comparatively is still doing fine. The problem is that you have similar lenders that are exposed not just to multifamily, but office buildings too. And the more issues they have in other asset classes like office buildings and have to write off loans, the tighter the credit ultimately will be for everyone in the commercial real estate world, including multifamily borrowers.
Well, in office, it was the double whammy. You know, you've got offices right now, office building owners that are making their mortgage payments because their tenants are paying the lease, even though the tenants aren't there or have 20% of their workforce there. And when it comes time to renew the leases, they may decide not to, or at the very least, want to negotiate a lower rate at the same time as these loans need to be refinanced at a higher rate. So that's certainly a precarious spot. What about the other asset classes that you guys deal with? You know, industrial market's been pretty strong. Retail's been hit or miss. What else are you seeing out there in terms of maybe sectors to keep an eye on?
Yes, so you mentioned industrial. Industrial certainly has seen a strong growth, generally speaking, but we also see some trends, particularly with these massive buildings that are 1 million square foot and larger, that are struggling to fill. So it really, you have to be very careful where you're active in some markets like, we are in Dallas, Fort Worth. Anything around the airport is just booming, and anyone who owns property, industrial property there is doing extremely well. But there are some pockets in Dallas, Fort Worth that are not doing that well. So similar to multifamily, in industrial, really need to understand your market. But overall, it's certainly still very good. Retail, it's really the same thing, right? Neighborhood retail has been extremely strong. We are able to get financing there done very easily. Hospitality is the usual case. As always, it's up and down. So right now, hospitality is doing relatively well, with obviously the economy doing very, very well too. And with everyone traveling, it's still that COVID effect with everyone now happy that they can travel. So that has done extremely well over the last year too.
Our guest today is Anton Mattli. We're talking about the state of financing for real estate. We'll have more when we come back. Plus, we're going to play real estate trivia next. You're tuned to the Real Estate Guys radio program. I'm your host, Robert Helms.
Real estate investment advice right in your mailbox. Sign up for the free Real Estate Guys newsletter at realestateguysradio.com.
As I speak, inflation is robbing you at a rate north of 10%. Last year, the number one zip code that Mid-South homebuyers offered income property to Real Estate Guys listeners in appreciated by 21%. To harness that spread and protect and grow your wealth in the current economic storm, you need the 2 decades of experience in renovation and management that Mid-South homebuyers brings to their investors. Every home Mid-South offers you will have brand new components, a new 30-year roof, and a high-quality renter, all in a price range under $150,000. Their empathetic property managers will use your ROI as their North Star, while the lack of repairs on their totally renovated properties contributes to their almost 4-year average renter stay and 99% occupancy rate. Learn about their lifetime occupancy guarantee and total 1-year maintenance guarantee by emailing midsouth@realestateguysradio.com. That's midsouth@realestateguysradio.com. You'll be glad you did.
If you love real estate and have always wanted to own your own business, listen up. The Real Estate Guys and their panel of experts want to teach you how to go full-time fast in the real estate syndication business. These next few years may go down in history as one of the best times ever to acquire investment real estate. There are deals everywhere if you know where to look and how to assemble the resources. The Secrets of Successful Syndication seminar will show you how to make big money doing big deals from a team of experts that have syndicated projects totaling more than $1 billion. Don't wait for someone to give you a raise. fees, or create a job for you. Attend the Secrets of Successful Syndication and learn how to build a team, raise capital, find deals, and make full-time money in 6 months or less. Go to realestateguysradio.com and click on events. All the big players use syndication as a way to diversify risk, optimize profits, and earn big money. You can too. Go to realestateguysradio.com and click on events.
Hi, this is Donald Trump, and you're listening to the Real Estate Guys.
Welcome back to the Real Estate Guys radio program. Thanks for tuning into the show. If you want to see a fantastic real estate market that is as beautiful as it can be profitable, then join me in wonderful Belize coming up in December. Our Belize Discovery Trip is designed to show you an awesome international real estate market like no one else can. Get all the details at realestateguysradio.com under the tab that says Events, where you'll find the Belize Discovery Trip. We're talking today about financing and what's happening in the world of commercial mortgages with Anton Mattli. Before we get back to the interview, it's time to play Real Estate Trivia, your chance to win a prize by knowing the answer to today's trivia question, which of course has something to do with real estate. When you hear the question and think you know the answer, send your best guess to trivia at realestateguysradio.com. Trivia at realestateguysradio.com. First person that gets it right gets an awesome book from our friend G. Edward Griffin called The Creature from Jekyll Island, a second look at the Federal Reserve. It's a big book, but it can be yours if you know today's real estate trivia question. Last week on the show, we had Dana Samuelson talking about precious metals, and we asked this: in which country did gold first appear in a coin? Well, the answer is Anatolia, also known as Asia Minor, during the 6th century BC. Today, the landmass of Anatolia consists mostly of the territory of contemporary Turkey. Here's our real estate trivia question for this week. Where was the world's largest treehouse? Yeah, I mean, there's a lot of tree houses all over the world, but there was one in particular that was super big. Unfortunately, it's not there anymore. But where in the world was it? If you know, or if you want to guess, send your best guess to trivia at realestateguysradio.com. Trivia at realestateguysradio.com. Give us your name, your physical mailing address, and the answer to the question so we can send you The Creature from Jekyll Island by G. Edward Griffin. That's today's real estate trivia question. We've got Anton Mattli with us, and he's a commercial mortgage broker, works primarily in a multifamily, but also has good visibility in the other sectors. You know, let's focus forward if we can, Anton. And a lot of folks listening have never invested in commercial property, or they're ready to make the leap into bigger stuff. Folks coming out to the syndication event in a few weeks, or thinking about making that jump into raising capital to do deals. And for most of these deals, you're going to want to get a loan. Despite the interest rates, it still can be a great time to leverage a property. What has changed? What do people need to know? They've got their eye on a deal. They need to probably get a loan. How early in the process do they need to talk to someone like you? And what do they need to know so that they have the best opportunity for success getting a loan today?
Yes. So what has changed? I think we only have seen a tightening on the banking side, right? We have all heard about SVB and Signature Bank and some of the others that have caused some issues in the banking sector. That isn't over yet, even though right now everything seems to be calm. We talked earlier about office loans. All of these commercial real estate loans that are sitting on books with a lot of these banks have a negative impact on their ability and willingness to lend. So one should just recognize that it's much harder to get loans from banks. If one is in multifamily, one always has the advantage that Fannie and Freddie are ready to lend. So that is a massive advantage compared to any other commercial real estate asset class. And so that makes it certainly much easier. Now, to the question, when should someone reach out to us as a debt broker? As early as possible. The environment is constantly changing. And as I mentioned, there are some lenders that are here today. They are dialing back tomorrow. So whatever is available today might not be available tomorrow, and someone else might pop up. So it's really important to be having that discussion early on. also equally important, come with a team that is really capable of doing that deal that you try to do. More than ever, it's not just the asset itself that is important. The team is now scrutinized more than ever, right? Particularly on the multifamily side, with some of these horror stories that we have heard, with a couple of foreclosures that has happened. Obviously, lenders are aware of those, and they will tighten their requirements when it comes to the teams. But that's the beautiful part, right? In commercial real estate, including multifamily, if you have some weaknesses from a financing perspective, from a personal financial perspective or experience, bring in someone else who has that experience, and you still are able to do that deal that you think is a great deal.
You know, in residential finance, there is the line of thinking that you should get pre-qualified, talk to your lender, make sure they've looked at your credit and your income and verification of income and all those things. How does that work on the commercial side? You're not really ready to underwrite until you have a property, but how much work can you do on the borrower and the team and the things you're talking about ahead of time?
Yeah, so we can pre-qualify, right? So the big difference compared to residential is in residential, you can get pre-approved, right? And once you have that pre-approval, you go out and you make offers on properties. And once you win it, then you close within a couple of weeks. Very easy. On the commercial side, there is no such thing as pre-approval, even for the borrowers. But what we still can do is the pre-qualifications, making sure that you and or the team has the required net worth, has the required liquidity, and has the required experience for the asset class and type and size that that team wants to buy, so that we can give guidance. Yes, I think this is doable for you, or I think you need to strengthen your team before you tackle that type of deal that you're looking at.
So, Anton, I know a couple years back you wrote an awesome guide to financing apartments, and we'll tell folks how they can get that before we're done. We're in the process of updating that because the world has changed and so forth. But you're going to be with us at the Secrets of Successful Syndication coming up in October, and I know it's a chance for you to get face-to-face with folks. And I would recommend that if you're thinking about either getting into purchasing apartments or other commercial property, or looking at syndicating, putting together capital to bigger deals, this would be a great place where they can spend some time with you and pick your brain a little bit.
Yep, that would be great, right? And events like SOS is just perfect, right? The reality is, particularly when you have already invested in single family, you think you can now go and buy commercial real estate. It's just much more complicated. And as I mentioned earlier, it is really a team sport. And how do you do this? You need to understand what needs to be done. And an event like SOS is just perfect to get your feet wet, if you want to call it that way. Obviously, it's just the first step to really get a better understanding what needs to be done. An event like this is perfect for that.
All right. Well, we'll look forward to seeing you there, and we appreciate your time today.
Yeah. Thank you for having me, Robert and Russ.
There's Anton Mattli from Peak Financing. Hey, if you want to get a copy of Anton's Ultimate Guide to Financing Your Apartment Complex, all you have to do is send an email to multifamily@realestateguysradio.com, multifamily@realestateguysradio.com. It's a great report, especially if you've never gone down the path of financing anything commercial. And then, of course, if you have other asset classes you're interested in, if you order that report, you'll be able to get Anton's contact information. You're tuned to the Real Estate Guys radio program. I'm your host, Robert Helms.
Need help with your real estate investment portfolio? Check out the resources page at realestateguysradio.com.
If you've been listening to the Real Estate Guys for a while, then you've heard about the legendary Investor Summit. Simply put, it's the highest level event we do. And the content, faculty, and attendees are amazing. If you're serious about taking your real estate investing to the next level, consider joining us. You'll spend more than a week with like-minded investors, world-class educators, and real-world professionals, and you'll have a blast. It all takes place next summer, so to get the details before they're released to the general public, send an email to summit@realestateguysradio.com with the subject Summit 2024. We'll add you to the advance notice list, and you'll be invited to spend a fun-filled week learning and networking with more than 25 class sessions and breakouts, plus small format roundtable discussions, great dinner conversations, and a ton of fun. Send an email to summit@realestateguysradio.com with the subject Summit 2024 and be among the first to get the details to join the Real Estate Guys and an all-star faculty on the 22nd Annual Investor Summit.
Having trouble finding deals where the numbers make sense? Invest in an asset class that delivers cash flow to you in good times and bad, and where most of that cash flow is tax-free. I'm Dave Zook. Many of you have heard me speak at Real Estate Guys events or heard me on their podcast. My team is a top 5 ATM operator in the country, and right now accredited investors can make cash flow returns well into the double digits and get huge tax deductions. For your free report on this lucrative asset class, email atm@realestateguysradio.com.
Hi, this is Darren Hardy, author of The Compound Effect, and you're listening to The Real Estate Guys.
Welcome back to the Real Estate Guys radio program. Thanks for tuning into the show. Hey, come hang out with the Real Estate Guys for more than a week at the 22nd Annual Investor Summit at Sea. Can't wait to get back on a cruise ship with some of our awesome, amazing faculty friends. You can add your name to that list and get on the advance notice list if you'll just send an email to summit@realestateguysradio.com and learn all about the Investor Summit at Sea, summit@realestateguysradio.com. Well, it's always good to hear from Anton and find out what is new in the world of finance, even though rates are still stinking high.
I just think it's so cool because he sounds like a Swiss banker. Every time we hear him talk, it's like, I just like to listen to him talk. No, he's super knowledgeable. He studies the market. Obviously, anybody active in the space sees a lot of deals, underwrites a lot of deals. When you're the brokerage business, I know because I was, and we were doing single family, small residential, but still the back and forth with the underwriters. And you can tell when underwriting guidelines are changing and when lenders are becoming more picky. You start to see the ratios change. And in commercial, they call it debt service coverage ratios, and residential, you call it DTI. But at the end of the day, you can tell when the lending is getting tighter or not. Sometimes some of the pricing changes, not just the interest rates, but some of the extra, what they call pricing, where they add points and fees for different things and whatnot. You see the trends in the appraisals, the arguments going back and forth as you're trying to negotiate value and look at rent rolls. And so there's no substitute for having conversations with people that are in the trenches on a daily basis. The news, the stats, all that stuff's wonderful if you want to look in the rearview mirror. But if you want to know what's going on right now, you got to talk to people and be in touch with people. So if you're a serious investor, the first thing you do is you build out your team. Who's on my advisory board? Who are the people that I'm going to stay in touch with, to listen to follow, to be on their email list, to listen to their podcast or whatever it is they have going on, how they communicate to their base. And then when it comes time for you to start thinking about doing a deal, that's when you get in, as Anton mentioned, get in early, start the conversation soon, begin preparing your credit profile, begin preparing your game plan, and stay in touch through that whole process, because you might say, oh, I got it all figured out 6 months from now, I want to do something. And during that 6 months, things change. And during the 6 months, you may have to change what you're doing too along the way. So communicate. Very, very important.
If you'd like a copy of Anton's report, just send an email to multifamily@realestateguysradio.com. Then come on out to the Secrets of Successful Syndication, October 6th and 7th, and you can meet Anton and pick his brain. All right. Well, hey, we have a Real Estate Guy surprise for you. Look who has just joined the studio. It is our good friend, the editor of the Gold newsletter, Brien Lundin. Hey, Brien.
Hey, guys. How are you? Great to be with you.
Well, it's great to have you in for a second. We're talking about financing today, and we're going to kind of make a correlation between maybe what the metals do in the market and where financing goes. But we'll leave people on the edge of their seats for a minute. We had Dana Samuelson on the program, your good friend, last week. But give us maybe the nickel tour on what you're seeing in the gold market right now, because a couple of pretty interesting things have happened in these last few weeks.
Yeah, it has been. And really over the last 6 weeks or so, we saw a major bond sell-off across the world, really. We saw rising treasury yields, and we saw commensurate strength in the U.S. dollar. All of those things are tremendous headwinds for gold. So what did gold do in the face of these really huge headwinds? Well, in August, it lost all of 1% in price.
Right. Basically
just stood like the Rock of Gibraltar in the face of these headwinds. So that is very encouraging. What I think is happening is that the bond market and the gold market, both of which are tremendously sensitive, predictive mechanisms, and really look forward to see what's going on in the macroeconomic picture, they're kind of feeling ahead for the next big thing. They're recognizing the essential fact that this rate hike cycle has peaked. Maybe we have another quarter point hike at some point later this year, probably not. It's higher for longer is what the Fed is saying, but I feel, and I think a lot of your listeners understand, that there are a tremendous number of candidates for events and developments out there that could force the Fed, and at some point probably will force the Fed, to start cutting rates far sooner than they ever expected to. So I think gold and I think the bond market are kind of feeling ahead and just itching to start pricing that next big thing, being Fed rate cuts into the markets.
Now, without getting too wonky, Brien, you put out an update this week. I love your newsletter, by the way, and you showed a chart that Tabby Costa put together about gold versus the 10-year real yield inverted. And those have tracked really, really closely for a long time, but that has just changed. Can you put that into layman's language for us?
Yeah, the connection has essentially broken in that with yields rising, with real yields, which are inflation-adjusted yields, rising to the point now where they're positive. We haven't had that for really since COVID started, and then only for a very brief period before COVID and after the great financial crisis of 2008. So we've been in an era of, they call it financial repression, where the Fed is forcing rates lower, interest rates lower. And that combined with inflation means that we've had negative real rates adjusted for inflation. Just very recently, that's changed. With inflation, at least the measured inflation rate, coming down, then real rates have actually gotten positive for a period. That should be, like garlic to a vampire for gold. Right. It should be very negative for gold, but it hasn't been. Gold's held steady. And I think that's because what we've done, or what the Fed has done, has gone from the easiest monetary policy in human history to one of the harshest tightening cycles ever seen at the flick of a proverbial switch. Very quickly, the situation's changed, and it's been doing this to a U.S. and global economy that was built on a foundation of zeroed interest rates. So something's going to break. Probably quite a few things are going to break, and I think the markets are sensing that.
Well, it's always interesting to look at charts, especially of, otherwise disparate information. Let's bring Russ in on this conversation, because Russ, in many of your presentations, you kind of make a premise. You show what happened to gold when housing prices changed. And I think in light of our conversation today on financing, there might be something there to explore.
Absolutely. If you remember back on the summit when we had Danielle DiMartino Booth, who is often at the New Orleans Investment Conference. In fact, Brien has been so gracious to let me sit on some panels with her. I asked her, is the Fed going to raise interest rates until something breaks? And if so, what's that going to be? And she answered without hesitation, yes, they will continue to raise interest rates until something breaks, and what's going to break is the credit market. And when I look back at 2008, and I didn't understand the bond market, I certainly wasn't paying attention to gold back then. I was all in real estate all the time, and I paid attention to the mortgage market at the Main Street level. And it never occurred to me that credit markets could break, and that's why I was so vulnerable. But what I noticed was a correlation, a kind of this weird correlation, as real estate prices were collapsing, gold prices were spiking. And so we started attending the New Orleans Investment Conference, where I have gotten a lot of my gold education, and tried to understand that. And it really wasn't a correlation between real estate and gold. It was a correlation between gold and the bond market. And when the credit markets broke, which is the bond market, or the credit market collapse of 2008 was born in the bond market, when that broke, people who would normally look for a safe haven in bonds went someplace else, I think, and that was gold. And so I saw that correlation. I said, well, I don't know if the credit markets would break again. I don't know if this correlation is actually causation, but it's worth paying attention to gold. And I became very obsessed with both gold and the bond markets. Well, sure enough, here we are, and we've got this harsh interest rate raising cycle that Brien talked about. And the result is exactly what Daniel DiMartino Booth said, is a lot of stress in the credit markets. That's being reflected in high interest rates, mortgage apps at 27-year lows, inventory not moving. So supply constraints are keeping real estate prices up, but it isn't because houses are affordable. It isn't because people don't want them. It's just because there's so little demand that people that absolutely have to buy have got to pay whatever the price is. And so I think there's a bullish setup long-term in real estate too. It's a different discussion, but there is correlation between gold, bond markets, interest rates, and specifically 10-year yields, which is where mortgages and mortgage rates come from. So the health of the credit markets can actually be seen to a degree or reflected in what's going on in gold. So there is a reason why, as real estate investors, we pay attention to gold.
Yeah, thoughts on that line of thinking, Brien?
Yeah, one of the things that is out there waiting that might force the Fed and create that kind of a situation that Russ is referring to is the situation in corporate debt. We've talked for a number of years about all of the zombie companies out there that were barely able to make their interest payments on their debt, service their debts. And that was with debt that was set in a zero rate environment. Maybe they were paying around 3% or so in their corporate debt. If that debt, or when rather, that debt resets at current rates, it will absolutely be like an axe to the head of these zombie companies. They're going to go out of business in a flash. James Grant recently calculated that, and I forget what the actual dollar amount was in trillions, but just the additional debt service costs that will come about when companies are forced to reset at current rates is equivalent to the combined economies of Germany and Japan every year. So you're going to see really a tsunami of debt costs is just forming off the shore right now. And when that is going to hit is the question. It's going to hit not in years, but in months. And that, if nothing else, I think that will force the Fed's hand, because that will create not the kind of recession that the Fed is looking for, certainly not a soft landing, but that will create the kind of recession and economic slowdown that the Fed is actually dreading, because you will have corporate bankruptcies just spiking. And in fact, in August, they actually spiked to one of the highest levels ever.
With likely more on the way. All right. Well, Brien, we're getting ready for your annual event coming up, the 49th Annual New Orleans Investment Conference. We never miss it. I know you're excited about this year's lineup. Share with us some of the folks that are going to be attending this year.
Yeah, thank you, Robert. We always focus on big picture. We focus on geopolitics. We focus on macroeconomics. Then we drill down. So we've got everything covered this year. One of our headliners this year is Mattli, who I think is the most important journalist of our generation, is exposing all of the government efforts at censorship. Very important presentation from him. We have James Rickards. We have Danielle DiMartino Booth coming again. We have George Gammon. We have Konstantin Kizin. A lot of people don't know him, but he is, a British stand-up comic who is also campaigning with a kind of anti-woke message. Really entertaining and enlightening speaker. We have Rick Rule, probably the best commodity speculator, resource speculator in the world today. Brent Johnson, Lynn Alden, the smartest person in the markets today, bar none. Dave Collum, absolutely fantastic speaker, never holds his tongue. Peter Bookvar, the resident contrarian on CNBC. James Stack, who's pinpointed every bubble and every bull market of the last 30, 40 years. Peter Schiff, of course, we all know Peter well. Jim Urio, Tavi Costa is brilliant. And then literally dozens and dozens of speakers and newsletter writers and experts in every aspect of investing, every market. And of course, the amazing real estate guys will be there doing their standard enlightening and entertaining presentations. And Robert, you as one of our MCs will do another incredible job guiding the whole affair from start to finish. So very exciting. I literally think this is the best investment conference roster of speakers that we've ever seen for the New Orleans conference. And by extension, I think that means of any event ever hosted.
It happens November 1st through 4th in New Orleans, Louisiana. And one of the nights, the real estate guys hold a private party for our listeners. Also, many of the speakers usually drop by. And if you want to be invited to that and learn how to sign up for the conference, just send an email to neworleans@realestateguysradio.com, neworleans@realestateguysradio.com. Brien, thanks for popping in today. Can't wait to see you in November.
Guys, always a pleasure to talk with you. I'm so glad I popped in. Thanks for letting me in the door.
All right. Well, there's special guest Brien Lundin. Big thanks to Brien Lundin and Anton Mattli for appearing on the show today. If you're interested in Anton's report on commercial real estate financing, specifically multifamily, just send an email to multifamily@realestateguysradio.com. Next week, we'll talk about whether it's time to sit on our hands or get moving. It's going to be a great show. Until then, go out and make some equity happen.
This episode of the Real Estate Guys radio show is brought to you by Paradigm Life. Powerful cash management strategies using life insurance. Learn more at beyourbank.com. Mid-South Home Buyers. Low-cost, turnkey cash flow properties in Memphis, Tennessee. Corporate Direct. Asset protection strategies for real estate investors from attorney and rich dad advisor Garrett Sutton. Find these and other great companies under the Resources tab at realestateguysradio.com. To learn how you can expose your product or service to the Real Estate Guys audience, call 888-489-7723 extension 4. That's 888-489-7723 extension 4. Or use the feedback page at realestateguysradio.com. Thanks for listening, and we'll see you next week right here on the Real Estate Guys radio show.